Alibaba is a heavily depressed stock, but with the recent run-up in the Chinese markets, is it finally time to buy? Now, I recently started a position in this company after holding off for a number of years, and although I didn't really plan this position is already up nearly 40%. However, that's not the whole story because I used to own Alibaba back in the 160s and actually decided to cut my losses in the 120s by selling it all off, because over time I actually came to realize that Chinese stocks traded not just based on valuation, but they have a greater emphasis on government policies than their US counterparts. And so because of that, I decided that holding on to the company would be too much of an opportunity cost. In fact, before the most recent run-up, Alibaba has been trading in the 70s and 80s, basically range bound for well over a year. And the last time you can actually find Alibaba at these prices, you have to go all the way back to 2016, 8 years ago. In this video, I'm going to talk about what I saw that made me actually want to reopen a position in this company, because if you actually look at the earnings, you'll realize that their recent earnings came in really poorly. And in fact, it was actually management's words during the earnings call highlighting potential catalysts that actually propped the stock back up. But as always, potential is a dangerous word, so let's dive in. Now, I think there's already quite a lot of coverage of Alibaba and their business model on YouTube and how they make money and things like that, so I'm not going to bore you with that. What I'm going to do is actually just point out key pieces of information that I'm going to put towards my valuation model at the end, basically discuss, whether or not it's actually safe to finally invest in Chinese companies. And I think this is especially, an interesting topic for many of my viewers who might not be from Asian countries. Like, this might be a slightly contrarian view. And we'll basically use a DCF right at the end to see, what the market is actually pricing in for Alibaba. So if you take a look at Alibaba's business, I think many people like to call them the Amazon of China or the Amazon of Asia. And while I think that's not entirely true, there's definitely a lot of overlaps in terms of their businesses. And for me, there are three components of their business that I like to focus on. And the first being their core China commerce. So this is actually where the bulk of Alibaba revenue come from, which is their Tmall and Taobao arm. And honestly, it's actually not just China people who are using Tmall and Taobao. Singaporeans use Taobao a lot, especially, they're moving into a new place. They need to buy decorative items for their house or small furniture pieces and things like that. That's where they go to, because the prices are competitive and they deliver it right to your doorstep. And then there's Lazada, right? Lazada is basically Alibaba's attempt to penetrate into the Southeast Asian market. This is part of their international commerce arm. Honestly, because I don't really use even Shopee that often as a Singaporean, it's usually my parents who actually does all this online shopping. So I don't even have the Lazada app on my phone. I can't really tell you how good is it, but basically I don't really see many people using it. In Singapore, seems like around me, most of my friends and my families tend to use Shopee, but I definitely can see them trying to grow. They have a very big office right in the Bras Basah area for Singapore, which is near our city centre. And then at the same time, they're spamming ads all over social media. But I'm not someone who really does a lot of online shopping except for the random odd item here and there. So do let me know if you actually use Lazada and Shopee, which app you prefer. Do you actually use them 50-50 and things like that? However, I do have to say that at least based on my impression, right, especially in the last 1 year or so, it's actually Shopee and TikTok Shop that is actually the more prominent online shopping platforms, at least in Singapore. Now, their third component is the cloud business, which is actually quite exciting to me because they are the market leader in China, having a 39% market share. But under previous management, right, this was actually a pretty slow growing component of their business. For a couple of quarters, they were actually growing at about 2 to 3%. So if I take a look at the numbers, it shows 2% growth in September of 2023, 3% growth in December of 2023, and in March of 2024 finally accelerated back to about 6%. Now, I actually found this to be a missed opportunity, especially seeing how fast China's cloud market is growing. Of course, partnering the Olympics earlier this year to actually broadcast the 2024 Paris Olympics is a good move. However, I do think that there is more of a marketing stunt, basically getting their name out there rather than generating any real form of revenue growth. So I think, to me, I'll talk more about the implications of this growing cloud market in China and its effects on Alibaba's earnings later on. And so on top of all this, they actually also have Cainiao, which is their delivery and logistics platform. So this is basically how they get all their deliveries done. This, together with the other three segments that I mentioned earlier, basically make up over 75% of their revenue. The other 25% basically come from things like local consumer services, digital media, and a bunch of other smaller businesses. And so for me, these are icing on the cake. And at this point, I just want to say that sometimes when we consume information online, it's important to understand the media biases and our own biases as well. And I just want to ask that we keep an open mind as we go through this valuation. Because I think I understand the skepticism towards China, definitely. Later you'll see I actually also have my own reservations towards China. But at the same time, I think that a lot of these fears that the media portrays are overblown and over-exaggerated. So is China economy bad? Definitely, yes, right? But on the ground, they're not as backwards as the media makes them out to be. Chinese citizens are actually super tech savvy, and technology is far more integrated into their day-to-day lives than in many countries that I've been to in the past. Now, if I'm saying, things aren't as bad as what the media portrays them out to be, then why in the world is Alibaba stock down over 80% from all-time highs? And even after the most recent run-up, it is still down 62%. Now, I want to answer this question using my valuation framework, where I say valuation basically equals to sentiment times execution, and this can be actually used in a various number of ways. Now, this can be used to represent things like the PE ratio or even price to sales, because the sentiment here refers to whatever multiple that investors assign to the company, and execution is basically its growth in fundamental metrics. So if we take a look at price to sales, right, Alibaba back in June of 2024, just a couple months ago, was trading at 1.33 times price to sales. Now, even with the most recent run-up, it is only trading at 2 times price to sales, so you can actually see that sentiment is indeed very, very poor. Now, let's take a look at yet another measure, the PE ratio. Similarly, back in June, this was actually trading at 17 times PE. Hi guys, so basically, right, when I was editing this video, I actually noticed the PE ratio, when I actually referred back to June of this year, it actually showed June of 2023. So I went back to the website to actually try and find the PE ratio for June of 2024. However, it doesn't seem to be shown on the website. So let me show you. Let me see if I can flip this around. So basically, if you take a look, this is the PE ratio that I was showing you guys, 17.7, but the date actually shows June of 2023. The next data point immediately jumps to 7th of October 2024, which is today lah, right? 24 times PE. So basically what I have to do is I have to go back to the charts that over here, and I basically take a look at the PE ratio all the way back in June. So I'm basically using the PE ratio on the 28th of June at 71.8, maybe call it $72, and from there actually calculate back the PE ratio and actually find out that the PE ratio back in June of this year is actually 15 times PE. And after the most recent run-up today, it's trading at 24 times PE. Now, if you draw a line across their historical PE ratio, right, you actually realize that Alibaba tends to trade closer to a 30 to 40 times PE. Now, a lot of it, right, is usually down to the growth that the company used to have, which brings me to the second part of the equation, execution. Now, I'm not saying that there are completely no problems with Alibaba and the market is just misunderstanding this company. Alibaba's execution has been poor over the last couple of years. Now, I started this video actually saying that they were trading at 2016 valuations. But in 2016, the operating margin for Alibaba was actually 37%, whereas today it's closer to 12%. So you can see the contraction in growth rates, the contracting margins and things like that. So this is why investors are actually attributing a lower multiple to the company, and it's quite justified. And if you take a look at some of these reports, right, they have definitely lost market shares to smaller companies like Pinduoduo, but that's not the end of the story. More on that in a bit. Look, I'll give you an example of a company that I'm currently selling puts on Enphase. Now, Enphase is basically a solar company, and if Kamala Harris actually ends up winning the election, chances are there will be a greater focus on green energy, and because of that, I will have to account for things like tax credits, solar credits, and things like that. But if Trump wins, it's likely to be a more pro-business environment, and I basically have to account for lower taxes lah. So depending on whichever candidate actually wins the election, I can adjust my valuation model to account for their policy stance. And so I guess it's similar in China. We have to understand the stance of the government and what they're trying to do in the country. And the only difference I'll say is that, the impact the government has on the company. I think whether Trump or Kamala wins, right, we're not going to be too worried about how Enphase is going to perform. Whereas I think in China, the reach of the government is far more far-reaching. And it works both ways. I think we have seen it work for the good of companies, where it can actually step in and create partnerships like it did with NIO and Sinopec to make battery swap stations much more accessible for the citizens. But at the same time, they can also regulate companies overnight and keep growth and margins depressed for a long period of time. And I think it's just the nature of the investment cycle in China, and we mitigate that perhaps by, just applying a greater margin of safety. And so apart from Alibaba not being able to execute at the same level that they have done in previous years, what exactly caused the poor sentiment in the stock? And the first and most important issue is that you haven't hit the like and subscribe button. Thank you for your time, and back to the video. Now, I think the poor sentiment towards China started with the tech crackdown, where the CCP actually blocked the IPO of Ant Group. They also carried out bans on gaming and live stream, and I think fears will further stoked when Jack Ma basically disappeared from the public eye for a long period of time. Of course, during this period, the US and China tensions also rise quite substantially. And And of course, the age-old concern that, Chinese companies are fake reporting. And honestly, I think that happens way less than we actually think that they do. But I think they definitely do themselves no favors with companies like Luckin Coffee actually ruining their reputation. And so the problem with Alibaba is that their execution has been poor, in part due to the government, but actually also in part due to their own internal mismanagement. And I think this definitely justified their lower multiple. Now, you add on to that all the other things that we actually talk about, and you can see why sentiment around this company has been so poor and the stock price has been depressed for so long. It's definitely going to take some time for them to regain investors' trust again. So why exactly did I choose to buy? And so the most important reason is basically something I've been talking about all throughout the video: understanding government's policies and the government stance. Now, if you take a look at whatever that is happening in China, we can actually start to sense that the CCP has started to pivot. Now, I think this pivot happens in two stages. Firstly, I think we see in articles like this Straits Times article that all the way back in 2023, Chinese government basically relaxed on their crackdown on the tech sector. They allow the resumption of, video gaming licenses to be released to companies like Tencent and NetEase. At the same time, they allow, Didi, the ride-hailing company, to, onboard new users. And even the Ant Group investigation is finally done and they were basically let off with a fine. Now, I think another interesting study I came across was this Goldman Sachs piece that talks about China's common prosperity mandate. I think from an outsider perspective, definitely, it seems like this is not going to work like common prosperity, but of course, I'm open to be corrected on this. But for me, what makes it interesting is that when you look at this graph that Goldman Sachs released, right, it actually tracks keywords that are being used on Chinese news platform and relates it to the theme of common prosperity. Now, the light blue line shows the frequency of common prosperity mandate being pushed by their mainstream media, and the dark blue line basically shows the corresponding market performance during that time frame. Now, it definitely seems like each time there's an overemphasis on all these ideological politics or policies, right, markets tend to do poorly, and as the emphasis lessens, growth is promoted and markets tend to rebound. Now, you add on to the fact that the Chinese government is aggressively stimulating the economy due to fears of missing its 5% GDP growth target. They have actually cut mortgages by 50 BP, supporting lending by lowering the capital reserve ratios of banks, and they even ease restrictions on borrowing, so that consumers can actually invest in stocks and shares. And to me, this last one especially is a little bit of a double-edged sword. So let me explain. Now, recently, right, I was watching Master Leong's video. If you don't know who he is, he's someone that does very good coverage for Hong Kong and China markets. And so in one of his recent live stream, he actually shared how Chinese influencers have been encouraging their followers to buy stocks on Tuesday right after China's National Day holiday is over. Now, I think the rhetoric in China is basically, they're encouraging the common folk to buy stocks, to buy up shares of companies, and to partake in the growth of the Chinese economy, which is the far cry from, the crackdown of all these tech companies in the past and things like that. And so all these influencers, to me, right, they're basically just stoking the FOMO flames of the Chinese people, telling them, you have to be fast on Tuesday. At market open, don't wait for any potential dips and things like that. You have to go all in on Tuesday because that's what they're going to do as well. And basically they actually tell their followers, right, that actually if you place an order even at market open, circuit breakers may come in because of the huge demand and you may not be able to get the price that you want. So I think because of all this, they're actually generating a lot of demand, a lot of FOMO, especially, during this National Day time, people actually cannot buy anything in the stock market, right? And why I'm mentioning this is because, a lot of these Chinese citizens have no investing experience. They have been advised to buy funds, buy ETF, which, likely will hold Alibaba because it's such a big company, such a household name in China. And it's definitely good for us as Alibaba investors. But what scares me is that we really don't know how leveraged the Chinese consumers are. And if, there's a reversal in their lending policy and things like that, right, markets might implode on themselves lah. So of course, I'm interested to see how this plays out, to see whether or not there's really such a huge demand on Tuesday. And this is actually only the start of the cycle. And of course, the honeymoon can last for a very long time. And all I'm saying is that don't be blinded by the gains and have an exit strategy. Identify in your portfolio right now, especially if you're invested in Hong Kong and China, which companies are, you're holding it for the long term, which companies are more swing trades, and, you actually plan out your exit along the way. And don't sit in front of your computer, watch the price action, and then make decisions on the fly. Because chances are you'll be swept up in the emotion and things like that. And this is probably a topic for another video, but I just don't have a good feeling about this. It just feels like an accident waiting to happen. Borrowing to buy stocks. It's just never a good idea. And all the more these consumers has little to no prior knowledge of investing and how to actually manage their positions. So, when they actually borrow money to buy stocks, it's quite scary. And I think the hope is that the wealth effect generated by the stock market going up will encourage spending. And I don't really see how that works, because you borrow money, you put it into the stock market goes up, you feel wealthy, you need to take your wealth out from the stock market, which then cause the stock market to drop. I don't know how that works. So personally, for me, I'm just worried that the Chinese consumer will be hit. It's a long shot for this to actually work from how I understand this. Even if it's a fix, it's just a quick fix. It doesn't actually, fix any structural issues within the Chinese economy, and it may be just papering over the cracks for now. Short term, definitely bullish. Logically, long term, I would want to say it's not that fantastic. You're just basically kicking the can down the road. Maybe, they have so many problems, and this is just one of the ways to solve this problem right now. I don't know enough about the Chinese economy to make a more definitive statement, but I'm reminded of the old saying, that markets can stay irrational way, way longer than you can stay solvent. So I'm not saying that, you definitely have to sit out. There's a lot of risk involved. You do whatever you want to do with your money, because valuations have really, really been compressed in the Chinese market. So there are definitely room to run. But my gut feeling tells me that this isn't a long-term fix, and so as investors, I am telling you, plan your exit if you actually have a position there. Don't just see, hey, wow, today's up 10%, 5%, 6%, and then you just switch off your portfolio and then don't look at it. Okay, sorry, I went off on a little bit of a tangent there. So back to the actual gist of the video. Basically, there's also a change in management, and their new CEO, Eddie Wu, is basically an internal promotion. He used to be the chairman of Tmall and Taobao and spearheaded Alibaba's transition into a more mobile platform. So he definitely has an eye for innovation, and even back in 2015, right, he actually launched his own VC firm that focuses on investing in tech and healthcare. And another very interesting fact that nobody seems to be talking about is that basically under other revenue, in their revenue segment, under others, right, there's this component where it's healthcare. And so, this is a guy that can actually potentially unlock some value in the healthcare sector for Alibaba, like what Apple is actually currently doing with their Apple Watch and things like that. So Alibaba is slowly becoming a holding company. And of course, there are some signs of, inflection in terms of their fundamentals on a quarter-over-quarter basis, not necessarily year-over-year, but quarter-over-quarter basis. Operating profits fell, right? Margins are lower than a year ago, but for the third quarter in a row, there's expanding operating margin. And then when it comes to net income, it's not yet a trend, but in the last 2 quarters, the net margins have been below 5%. At least now it's back to about 9%, and we want to see this trend continue. But most importantly, I think it's their share buyback program. This helps to increase their EPS, even though, profitability moving forward may be a little bit muted. So because of this, this is one of the fundamental reasons why I actually want to own Alibaba, is because of their aggressive share buyback program. And finally, Alibaba basically transitioned to a dual primary listing, upgrading its Hong Kong listing to primary status. So basically, this allows them to be included in this thing called Stock Connect. And basically what this means is that, mainland investors are finally able to buy the stock directly. So when some analysts were talking to Reuters, they basically estimate that there could be inflows of about 17 to 37 billion as it unlocks a new pool of buyers. And so to me, how I see it is basically all that's left is to wait for sentiment to flip. But let's further ground ourselves in some fundamentals by taking a look at earnings and, at least having an idea about the potential upside, so that you can decide for yourself whether or not this investment is for you, and if this investment is for you, where are some potential exit points. Now, I want to talk about the latest earnings that Alibaba released. When they actually released their most recent quarter earnings, right, the share price actually fell before recovering during the earnings call. So what exactly did the management tell us during the earnings calls that caused investors to buy back up the shares? Now, the first thing I believe is that Baba actually reiterated their commitment to share buybacks. They bought back $5.8 billion worth of shares in this most recent quarter, reducing the shares outstanding by 2.3%. Now, they also have a further $26.1 billion left to deploy over the coming quarters for share buybacks all the way through to March of 2027. And so basically, if they maintain this pace of share buybacks, they will have to renew their share buyback program within the next 4 to 5 quarters. So I've plotted out the change in the number of shares outstanding as compared to their share buybacks, and you can see as their share buybacks continue to ramp up, number of shares outstanding fell. So on top of this, they also converted some of their employee stock options plans to cash incentive, which prevents dilution. So all of this, good news for investors, perhaps not so good news for employees, which is a lesson in and of itself, right? You cannot just be an employee anymore. But before we continue, let's take a look at why investors actually sold off the stock in the first place. If you take a look at their actual earnings, right, operating income was down 15% year over year. Net income was also down 27% year over year. So this was a pretty bad earnings results overall. So like I was saying, it's actually the margins on a quarter over quarter basis that started to inflect upwards. But you can still see over here that there's still a long way to go, because on an absolute basis, they are still contracting. And so we need to dive a little bit deeper into each business segment to get a better understanding of what the heck is actually happening in this company. Now, if we take a look at their segment results, I'm just going to point out what I feel are their biggest growth drivers over here, which management also brought up during the earnings calls. And the first one being their biggest revenue driver, right? Their Taobao and Tmall segment. Revenue in this segment basically contracted 1% year over year. So basically within Tmall and Taobao, right, basically there are three different revenue segments. And one of these revenue drivers is called the customer management relation, or CMR for short. So this is basically fees that Alibaba makes off merchants that actually use their platform. And what they have done recently is that they have integrated some new algorithms, some new marketing algorithms that help make the platform more efficient for merchants that actually sell on their platform. And so because of that, they actually notice an uptick in gross merchandise volume, means the number of transactions that occur on their platform. And so their gross merchandise volume, or GMV for short, actually grew by high single digits, which means around 8 to 9%. And so what management actually pointed out is that, this actually shows that, the new algorithms that they're employing, the new marketing models that they're using to run their platform are basically giving them encouraging results and are attracting merchants to come back onto the platform, because previously we were saying they actually lost market share to companies like Pinduoduo and things like that. So now they're basically trying to win back market share, and by using all these marketing models to actually show that their platform is better than their competitors, they're actually slowly attracting customers, merchants back to their platform lah. So the only issue here is right now, because all these marketing models, all these new algorithms are still fairly new, and they're also in a phase where they're actually attracting back and trying to win back market share. So monetization is not the focus. When it comes to monetization of this platform, they basically guided that it will take another 6 to 12 months for them to fully scale out the platform and start to monetize the platform. And what kind of growth you can expect, right? They basically tell us this customer management portion, you can see growth to be in line more or less with GMV growth. So as GMV grow, the customer management relation segment will grow as well. So which means we can expect both to come in at around high single digit growth. Another issue that actually caused the contraction in their Tmall and Taobao segment is their scaling back of their 1P business. Basically, this is their first party business, which is basically not as efficient as the other components of the business. And so as they scale back, naturally this 9% loss of revenue is self-inflicted, all in the name of driving profitability in the long run and making their business more efficient. So overall, I like this streamlining of the company and being more aligned with their long-term vision of helping people do business anywhere. Now, the next segment that actually got investors excited, right, is their cloud segment, reaccelerating growth to 6% after coming in at 2 to 3% in the last couple of quarters. Personally, I've actually been a bit more impressed with the turnaround of Taobao and Tmall rather than their cloud segment. Now, this has really to do with market share. You see, China's e-commerce market has been growing at about a 9.9% clip. So when they actually tell us that they're growing the gross merchandise volume, or GMV, at Taobao and Tmall by a similarly high single-digit percentage, it shows that they're able to defend market share, which is what they're trying to do. They're trying to actually defend their market share and win back market share that they have lost in the past. And so the issue of monetization will come with time, and then we basically have to give them time to execute on what they're trying to do. However, China's cloud market is actually growing very quickly. The infrastructure component of the cloud market is actually growing at 22%, and the cloud services is actually growing at 16%. So when AliCloud is doing, 2 to 3% growth in the last couple of quarters, basically they're actively losing market share. So even at 6%, although it's a reacceleration, it's still well below the growth rate of the current market. So in the earnings call, right, management tried to allay fears of investors by saying that, the AI budgets of companies around us have significantly went up. So they actually used the word, the AI budgets are significantly higher. And that's the exact word that they use. And so, as an investor, I would want to hold their feet to the coals and say that, I want to see then a significantly higher growth in your cloud revenue. Because if it doesn't materializes, one of two things must be true. Either number one, your clients are choosing your competitors over you, which is why you're not capturing the significantly higher AI budgets of companies, or you're just saying nice things to investors, and then basically, moving forward, I will take your words with a grain of salt. Very least, at least they gave a timeline. They told us that, by the time second half of the year come around, and in Alibaba's term, that means from October 24 to March of 2025, we'll actually see the real reacceleration of the cloud revenue. So that is something we are going to hold them to. So on top of all of that, naturally their international e-commerce business is doing well, growing at 32%, and they also guided for an increased capex spend because of the AI demand. So they say that, every time we build out a AI structure, AI server, basically it's always at full capacity right from the start. So that is something that we are going to have to value accordingly. And so we can see over here, right, Alibaba's revenue growth has been declining over the years. And, I just want to point out that if if you take a look at their revenue over here, because I'm actually looking at it through the US dollars, there looks to be a contraction of about 6% between 2022 and 2023, but I believe that's largely down to the effects of the currency exchange lah. Because when I look at it in the Chinese dollar, the renminbi basis, right, it's actually a slowdown in revenue growth to 1.8%. So revenue was still growing, but only growing at 1.8%. But I think because when you account for the currency exchange and things like that, that's where you see a negative 6% growth on a US dollar basis lah. So for this valuation, we are going to use a 10% WACC and a 3% terminal growth rate. The cash on hand for them is 84 billion US dollars and debt of 28 billion US dollars. This is on their balance sheet, so they basically have a pretty strong balance sheet. In terms of capex, what we're going to do is we're going to take 6% and lower it 1% every single year until we reach a steady state of 3 to 4%. What I'm going to do is I'm going to take you through 3 possible scenarios and show you where we end up in each of these scenarios, and you can decide for yourself whether or not you're comfortable with the valuation. My first scenario assumes that the Chinese government continues to be heavy-handed, not letting Alibaba grow, controlling their profits, which means 0% revenue growth for the next 5 years and cash flow margins to contract further from the current 20% rate to around 15%. Now, if that happens, Alibaba should be worth about $107 today, just a hair below where we are. Now, a very quick note, right? What I actually realized, using the same projections, if I increase the cash flow margin to 16%, then the price is basically, the price at where we are today, which means that we are fairly valued. Which means right now, if you are buying Alibaba in the $114 range, the market is expecting Alibaba to have 0% revenue growth and 16% cash flow margins. Now, the second scenario assumes Alibaba doesn't grow between 2024 and 2025 as they restructure their business, and thereafter basically continue to grow revenue at 3% with 20% cash flow margins, which is their 2024 performance, and that itself was pretty bad. But we assume they never ever do better than that for the next 5 years. Then if that happens, they should be trading closer to $150. Now, the third scenario over here basically assumes Alibaba grows at a 5% rate. Now, why 5%? I did not just pluck this number out from the air, because that's the pace that the Chinese government wants to grow their economy at, and the Chinese government basically wants to grow a growing middle class. And my assumption is that Alibaba is a reflection of the Chinese consumer and of the Chinese middle class, and so I presume that they can keep pace with the broader economy. Now, in terms of margin, they will remain at 20% over the next 2 years as they continue to restructure their business and then work their way towards a low to mid 20% cash flow margins lah. And if all of that happens, Alibaba should be worth north of $197, perhaps closer to $200. So I think overall, with the Chinese government pulling back on the common prosperity rhetoric, I think the aggressive stimulus measures actually make China an attractive short to mid-term option. I do feel that a lot of the perception around China is overly exaggerated, and if you're worried about the government or some ideological differences, all these can be accounted for within the DCF by giving a larger margin of safety. And so basically, if you take our last 2 scenarios at 3% revenue growth, 20% cash flow margins with a 20% margin of safety, its fair value will be closer to $120. But at 5% revenue growth and a low to mid 20% kind of margins, right, its fair value is closer to $160 lah, which depending on your entry price might be attractive for some of you. However, with that said, I think management really does need to earn back investors' trust. I think you can tell by the way I talk about them that I don't fully trust the management as well. I mean this purely because of valuation, and it looks attractive to me even after accounting for all the policy risk. And I do believe that Alibaba is going to be a big part of the Chinese economy moving forward lah. So of course, if management achieves its guidance, if they reaccelerate cloud revenue back to double-digit growth, if the e-commerce platform continues to grow at high single digits, then Alibaba will really, really do well. However, the truth is we don't actually need all of that to happen for this investment to do well, because what we're doing is that we're buying into a recovery story with an aggressive buyback strategy that aims to improve EPS over time. However, if you still feel uncomfortable with this investment, then this company over here has stellar management and is poised for growth as the rate cut cycle begins. And if you're not one to stomach volatility, then this company here is a beaten down value stock with a brilliant CEO at its helm executing its own turnaround story. And these companies will give you a better idea of what to look out for in a management team and a good investment. And with that, I'll see you in the next one.